Hello and welcome to this episode of Mic'd Up. I'm Pete Seyler, part of our business development team here at iCM. And today I'm joined by iCM's Chief Investment Officer, Mike Paciotti. Mike, thanks for jumping in.
Morning, Pete.
All right, Mike. So as we come to the end of 2025, let's really start this on the positive side of things. When you look back at the year, what strategy, themes, or market calls worked particularly well for you and the team? And what would you say drove that success?
So 2025 really across the board was just a good year for investors with most things doing well. So we're recording this through mid-December, so a lot of this information is through the end of January, or end of November, I should say. U.S. equities advanced through the end of November by about 17% for the 11 months, and U.S. bonds gained about 7.5%. So the backdrop was generally consistent with strong earnings growth, but some weakening of the labor force, which was really kind of driving the Fed to become less restrictive in their monetary policy. Now, that combination of strong earnings and a less restrictive monetary policy is really kind of a Goldilocks scenario for investors. Now, the other thing that was going on is that the dominance of U.S. equities for the past decade was often due to valuation expansion, particularly in tech. So really, as opposed to universally superior fundamentals. In 2025, that whole multiple expansion dynamic appears to really have lost some steam as concerns began to really emerge, not only about the level of valuations, but about the quality of earnings in particularly in growth space. So, and kind of ironically, out of all the trade deal drama that we had earlier in the year, really kind of came a reinvigorated Europe, right? In March, the European Commission unveiled plans calling for an $800 billion defense spend. Germany, which is really long known to be really fiscally conservative, passed a sweeping spending package for 500 billion euro infrastructure spend. So you had really this strong fiscal support combined with a more aggressive monetary policy. And it's really set the backdrop for non-US strength, with non-US value gaining 36-ish% again through the end of November, through 11 months of the year, and emerging markets equities gaining 30%. And you also had emerging markets debt gaining 17% through that same period. So really strong period for the non-US assets.
Now, with that said, though, growth stocks really continue to defy odds and look likely to pull, another small victory out again this year within the U.S. And I've heard you talk about some, linkages in that space that are reminiscent of the old Minsky feedback loops. Can you address that for us?
Yeah, well, domestically, it looks like that might be possible, although these last couple of days have certainly favored value. So we'll see about who's going to actually win this race through the full year. The bigger thing that you're kind of referring to here with the Minsky feedback loop and the rather large elephant in the room is this whole AI private credit vendor financing arrangement that's emerged. So the issue, in short, is that AI companies are kind of creating their own demand by vendor financing their products to startup AI companies, which are ultimately financed by stock offerings or by private credit. So let me give you an example. So the big one was the NVIDIA OpenAI deal, which was recently announced as a partnership under which NVIDIA intends to invest up to $100 billion in OpenAI as part of this massive AI infrastructure build out. So let me kind of put this simply. OpenAI did a stock offering, which NVIDIA buys, sending that money to OpenAI, who in turn sends it right back to NVIDIA to buy their chips, right? So it's completely circular, right? OpenAI issued $100 billion in stocks, and mind you, they only have $4 billion in revenue and are upside down in profits. And they've ultimately committed a total of $1.4 trillion in these types of relationships. The whole thing is really all based on hope, and it's kind of pervasive.
So can you also talk and really speak to the link between this and private credit?
Yeah, so for others, it's not a stock offering that provides the funds, but loans from private credit. So now you have the same, quasi artificial demand and a loan that needs to be repaid to a lender in private markets, right? So now the problem here, or one of the problems here, is that many of these loans are being made with 5+ year terms. It's kind of common in private credit space. The problem is that the technology evolves so rapidly, it's obsolete in 18 months. So you have this classic asset liability mismatch and investors taking on really equity risk without the reward to go along with it.
So I think the big question then becomes, why use private credit? Why not public markets?
Well, because the lending standards are more relaxed than public markets, right? There's a lack of covenants in that space. So it's kind of easier to beg forgiveness or to get an extension on a missed payment because these things aren't readily marked to market. So and ultimately that's why you can kind of see that big high profile BlackRock Renovo issue that we saw about a month ago. So for those that aren't familiar, this was a private credit loan that was booked at 100% loan to value just a month or two ago and was written to zero all in one step, right? All the bodies were just basically hidden.
Do you see any connection on this to Main Street?
Well, potentially through the banks and lines of credit that they're extending to private credit funds. The insurance companies have some exposure through their general accounts by investing in private credit, with some estimates at about 17% of their fixed income book. The other thing that's worth kind of paying attention to is that it's also transferred onto the books of some of the investment grade players, Oracle and Microsoft specifically. So now Oracle has $300 billion of vendor finance arrangements with OpenAI, Microsoft 250. The difference is that Microsoft is a $3.5 trillion market cap. Oracle's only 500 billion. So this bet on OpenAI is 60% of Oracle's market cap.
Would you be concerned about Oracle?
Well, as you know, we don't do individual stocks, but yes, yeah. If I was an investor in individually in Oracle stock, I mean, basically, this might end up working out for Oracle, but they'll ultimately be in trouble if OpenAI, for whatever reason, really fails to repay this.
All right. So, given the current macro and overall market environment, where do you see the most compelling opportunities or safe havens for capital over the next 12 to 18 months?
Well, kind of ironically, and despite what I just said, I don't really think these things come home to roost in 2026, right? Typically, you see issues with these types of things when capital dries up or goes away. So, that's usually an economic issue. The economy should be strong in 2026, specifically due to some of the expense provisions in the big beautiful bill. In my mind, it's probably not coming from the economy. It would take really a series of high-profile defaults, kind of like the Renovo that we saw a month ago, to cause capital to dry up because investors really started to pull back from that space. Now, the good news, even in the event that it does, is that this environment is not like 2008 or even 2022, a couple of years ago. This is not an everything bubble. On the equity side, non-US equities are still cheap, even considering the gains that we had last year, especially really in the emerging world. Domestically, you have quality US value stocks, right? Of a very specific definition of value is as cheap as it's ever been. So you basically just want to allocate as much as you're willing to stomach outside of the U.S. and away from U.S. large cap growth. And for the fixed income, it's basically kind of stay away from bank loans, which are pretty much a close cousin to private credit. So for in that space, you're really looking at, for us anyways, a mix of emerging markets, local currency debt, and pretty boring broad vanilla treasuries is kind of the optimal mix right now.
Great. Mike, this has been great. I really appreciate you joining me today.
Oh, glad to do it.
And thank you to our viewers for watching this episode of Mic'd Up with ICM. If you have any questions or would like to suggest a future topic of Mic'd Up, please reach out to us at 888-426-4689 or via email at info@icm-invest.com. Be sure to like and share this video and subscribe to our channel to receive notification of new content as it's posted. Thanks for watching.